Hey everyone, my name's Andy. My channel's Finding Value. If you like making money, subscribe to the channel. Love to have you in this community. Let's ride this bull market up together in commodities. Let's crush this thing, really. I'm going to talk about risk and leverage. I know some people, they ask me about large companies, and I always respond that I'm in the small caps. I take a small percentage of my money, maybe 15% of my total net worth, and I go for it. I swing for the fences. I go for small cap companies in highly asymmetric bet areas, ones that are very highly undervalued with very large outsized returns. I identify it and I swing for the fences. So I'm going to go over risk and leverage in this presentation to kind of catch everyone up. I've done this presentation once before, I think. So disclosure, again, the views in this presentation are for educational purposes only. It's not financial advice. It takes many years of experience to get to the level of advice I'm giving here. You are responsible for your own decisions. So large returns. We use ratios to determine value. Dow to gold ratio, gold to oil ratio, doesn't matter what it is. We use the ratios to identify value. We look at market conditions next. And what market conditions are is residential real estate to see if it's going higher. If it's going higher, we are in an expansion phase of real estate. And in an expansion phase of real estate, it is inflationary. That is where the money gets into the system through a fractional reserve lending system. And right now, they're piling on more money, just sending out checks to people. They're piling it on. So they need inflation. They want inflation. They need inflation, the Federal Reserve and the government. And they need to inflate the debts away. We've got lots of debt, high debt. And if we get a green light on all of these ratios, market conditions, if everything aligns correctly, if the moon is aligned with the sun and the earth, it's time to choose these companies. We need to get in them. We need to invest in them and hold on for the big move. Ratios are low, and guess what? It's a green light. This isn't the time to play defense. This is the time that I go for it. This is when you swing for the fences. This is when the risk is the lowest and you pile into the most risky stuff. The risk is already sucked out of all the stocks. By choosing large companies, you are literally capping your upside. With my speculative money, remember, I am using my speculative money, 15% of my net worth. I am swinging for the fences. I'm going for it big. I'm going for the micro caps. I'm going for the small caps, and I'm going for anything that's of the smaller nature. Now, why would I do that? Let's just look. Gold, silver, and platinum, last bull market. Gold went up an 8x, silver 24, and platinum a 7. On the right-hand side, Camco went up 8 times. Uranium itself returned 15x. Conoco went up 4x. Oil returned 14. Rio Tinto went up 13.3x. That is a big diversified mining company. That is extremely low risk, Rio Tinto. It's got high dividends. Why the heck would I choose ConocoPhillips and why would I choose Camco? There's no reason to. I'd rather choose physical precious metals, gold on the left-hand side, which has literally no risk. I'd rather choose silver. I'd rather choose platinum. There's no reason to be speculating in ConocoPhillips. There's no reason to be speculating in Camco. If uranium went up 15x and Camco can't provide the returns of 15x, why be in it? You might as well just pick Uranium Participation Corp. It's got less risk. Remember, this is just my opinion, guys. I'm going after the small stuff that's going to be going up 50 to 100x. That's where I'm going. And I'm diversifying out. So small companies, they can grow reserves, they can grow production, even in a scarce world of oil. They get hammered much more so than the major companies on the downside. So their movements are much more volatile. They have a lot of leverage to the price of the commodity on the upside. Align yourself with big stakeholders that have big stakes in those companies, and remember to choose proven management teams. Again, my choice, I would rather choose underpriced metals at a lot lower risk than choose a lot of these large corporations. I want leverage to the price of the commodity, not underperformance to it. The physical precious metals are much lower risk bets, plus they outperform the majors after taxes. Far better opportunities ahead of us with some of these precious metals than before in terms of supply-demand balances in the industrial worlds in terms of silver and platinum. So the conclusion here is I want massive leverage to prices. Otherwise, I'm not going to go in and speculate. I'm just going to do the physical precious metals. If the risk is sucked out of the stocks, then that is the time to go with the high risk stuff because the rewards are outsized. Asymmetric bet is what this is known as. You can lose 100% of your money, but if you can get 100 times it, that's an asymmetric bet. You're putting up you're risking a lot less capital, and your returns are far more outsized. Reduce risk by doing analysis and betting on proven management teams, and by actively looking at position sizing. That is how you manage your risk. You can speculate on companies who are drastically underpriced, and speculate on an asset that will be drastically repriced in the future. So the name of the game here, and the way that my viewpoint is, and again, this is my viewpoint, is I spread my money amongst some very high, very big asymmetric bets. Your upsides are so large in relationship to your downside, and when you're buying it, when the ratio is this cheap and it's starting to come out of the bottom and move up, your risk is extremely low. This is the time you hit the full risk button, is when they're down, they're out, all the risk has been sucked out of them. Your ratios are telling you that it's never been this cheap in the history of ratios in terms of these assets against each other. You hit the full risk button, you can get massive rewards. I'm talking massive. Now, I'm not telling you to go pile in a bunch of exploration companies. You need the companies to follow the price of the commodity. So a small cap company, something like, I'm going to use oil here, SM Energy, Centennial Development, they've got high debt. They were literally sold off to 1% of their all-time high. If that unwinds back and you can catch it, but there is a risk of bankruptcy. If it if it unwinds and comes back to, let's say oil goes in a massive bull market. When this all unwinds, you could see those companies go to 3x of their all-time highs. You went from 1% of their all-time high all the way to a 3x of it. If their all-time high was $30, you could go from 60 cents to $90. It's a 100-bagger. It's over 100 times your money. It's possible. Now, we're not at the bottom of the bottom anymore, but we still have 10 plus X on a lot of these companies. So I'm swinging for the fence. That's just my style. If you guys are playing with a larger percent, I'm only playing with 15% of my net worth. If you're playing with a larger percent, you're going to have to reduce your risk on some of your portfolios. You're going to have to reduce a good portion. Maybe you take only 10 or 15% and swing for the fences. And then the other portion, you're going to have to go with lower risk plays, go with some diversified miners, go with some royalty companies. They still have incredible leverage without the risk. So keep that in mind, that I am focused with a small percentage of my portfolio in these. I still put in money in some of these royalty companies, in some of these other areas that I think can really push it. They're small cap royalties. That is a really good sweet spot to be in. That's what I really like those companies. And you'll see a lot of my wealth go into those. I also think that some of these uranium companies, it's so cheap, they're so small, they're so out of favor that you could see some spectacular returns there. So whenever you have those setups, I just kind of spread it out, get it into the really small cap companies. Just a little bit of money can go a long way. $200 even can turn into $100,000 with a 500 times return. If one of these little companies hits it big, they find a big deposit, whatever it may be, and there's not that many companies. There isn't really that many. Let's say there's 10, you put $200 in each, that's $2,000 that you're risking. One of them hits it, boom, you kill it. That's my approach, that's my strategy. You guys can obviously have whatever strategy you like. This is not advice, it's just financial education and a different viewpoint looking at your portfolio. If you guys like this content, give me a thumbs up. Leave comments below if you guys agree or disagree. And thank you for listening. This is Finding Value.